This is your Mortgage Rate Watch for Wednesday, December the 29th, and I'm Keith Akada with the Mortgage Reel. So here at the top of the hour at 10 o'clock, we just had the 7-year bond auction, which produced an A rating, and this is in total opposite of what happened yesterday with the 2-year auction, which got a B plus rating, and there was a huge sell-off. So with the A rating, we're definitely looking at the bond page. We're seeing a great rally for the market, which is much needed to improve rates. And we basically took back all of yesterday's losses. But one thing we want to forewarn for the future, using this as a classic example of how volatile rates can be when customers ask us, how can rates possibly change this much just overnight? It is very pivotal moving forward, looking at the bond auctions due to quantitative easing 2 with the amount of supply of bonds coming up in 2011. Every time there is an auction on the market at 10 o'clock, West Coast time, especially for those here in Washington, it's going to be critical that we pay attention to those because those can move the markets. And this is a true example without any type of speculation involved that when you have amount of supply in the market and people are concerned about what's going to happen when investors do or do not buy those bonds coming up for auction, if the bond auction performs weakly, guaranteed that's going to pressure yields to move higher. Yields move higher. Homeowners, shocks interest rates move higher. When the auctions come off well and investors come back in because they think there's a bargain in the market, yields on those bonds move lower, and then the mortgage rates will move lower. So it's a direct correlation right now. This has nothing to do with a 10-year bond. It just has to do with everything in general with the auction results, because anything in long-term debt is going to be translated to those mortgages, because again, long-term debt, meaning 15 and 30-year fixed mortgages, those have to find a home for investors to buy. And if investors don't think that those bonds are worth the value and the yields aren't high enough, there's not going to be the amount of demand there, and then without demand, that's going to push rates higher. So we just wanted to use that as a great example for today, but we need this sigh of relief to keep this rally in interest rates from moving higher and sustain it and take back some of those gains. So definitely, if there's any other breaking news, make sure to follow us on our Facebook fan page. We'll be putting out some more information there. Otherwise, our Twitter page is also available. On the Facebook fan page is How to Beat the Banks with more information and breaking news. We'll be back tomorrow. I'll talk to you soon.